MBU, the source is the reason for the profit every season. If you know, then you know. Disclaimer, this video is for educational and entertainment purposes only. I am not a financial advisor, and neither is MBU. We do not sell signals, we do not promise profits, and we definitely do not guarantee results. We teach strategy, not gambling. YouTube's rules are very clear. No guaranteed income, no get rich quick, and no financial recommendations pretending to be advice. Everything you hear today is about helping you understand the market so you can think better, not chase hype. So, if you hear the word profit, understand it's about process, not promises. Now, with that said, go ahead and hit that like and subscribe button right now because what we're about to break down will change the way you look at options trading forever. All right, family, let's talk about Delta. Delta is like your option's heartbeat. It's that little number that tells you how much your option moves when the stock moves $1. But here's the thing most people miss. That number isn't just movement, it's probability. It's your chance of winning. So when you see a delta of 0.30, that's not just a number. That's roughly a 30% chance that your option will finish in the money by expiration. It's like walking into the market with 3 bullets in a 10-round clip and hoping you don't miss. Now, family, think about this. Most beginners buy cheap, low delta options because they look affordable. They see that little $20 or $30 contract and think, that's low risk. But it's not low risk. It's low odds. Low delta means you're starting the game from behind. You're already losing before the bell rings. Every candle that doesn't go your way hurts more because your contract doesn't have the strength to fight back. All right, family. Picture delta as your muscle. High delta means you've been training, you've got endurance, you've got staying power. Low delta? That's like skipping leg day your whole life. You can't hold your weight when the market pushes back. Now here's where it gets real. Most beginners don't realize that low delta contracts get crushed twice. First, when the stock moves against you. And second, when Theta, which represents time decay, comes through and eats what's left. Theta doesn't care how you feel. It's that silent clock ticking every single second, draining value whether you win or lose. That's why your cheap low delta contract looks good today and worthless tomorrow. Now, family, let's say you bought a low delta call for $20. The stock goes up $1, but your contract barely moves. Why? Because your delta might only be 0.15 or 0.20. That means for every $1 move, you only gain 15 or 20 cents. But when it falls $1, you lose that same amount plus the time decay eating your premium alive. Now check this out. If you had a high delta contract, maybe around 0.70, it would move almost dollar for dollar with the stock. The stock goes up $1, you gain about $70 in value. The stock goes down $1, sure you lose $70, but it's consistent, it's predictable, it's stable. All right, family, consistency beats hype every time. High delta isn't flashy, but it's reliable. It holds up better when things go sideways because it has weight behind it. That's why I tell people all the time, cheap contracts are like junk food. They look good, they taste good, but they don't build muscle. High delta contracts are like real nutrition. It's not about the thrill, it's about longevity. Now, family, imagine you're watching that chart and you see delta crawling on the floor. That's what's happening inside your contract when you buy something too far out of the money. You're basically betting on a miracle instead of a move. The market doesn't reward hope, it rewards preparation. And here's the trap. Most traders think cheap means less to lose. But in reality, it often means you're guaranteed to lose because the odds are stacked against you from the start. Think of it like sports betting. If you're betting on a team with a 30% chance of winning, you're gambling. But if you take the one with a 70% chance, you're playing the odds with discipline. That's delta in the simplest form. All right, family, let's make it visual. You've got 3 deltas standing in a row, one with 30% on its shirt, one with 50%, and one with 70%. Which one do you think will reach the finish line first? The higher the delta, the stronger the chance it makes it to expiration in your favor. But let's break that down even more simply for my beginners. Delta is like your yes meter. A delta of 0.30 means the market is saying maybe. A delta of 0.50 means it could go either way. A delta of 0.70 means we're leaning toward yes. So why bet on a maybe when you could ride with the yes? Now, family, here's where people mess up. They'll buy a 0.15 delta call, the stock goes up, and they get all excited seeing that green candle. But when they check their contract, it barely moved. Then they say, man, why didn't my option go up? Because your delta was weak. Low delta contracts are like trying to climb a mountain in flip-flops. Technically you can, but why make life harder? Now, family, if you take nothing else from this video, take this. Low delta contracts don't recover. That's why so many traders get frustrated. The stock can rebound, but your contract can't. Once it's drained, it's done. When you buy higher delta, you're buying time and power. It costs more up front, but it pays for peace of mind. You're not glued to the screen every 5 minutes because your contract can actually breathe. All right, family, this is the part nobody tells you. High delta contracts are where the institutions play. They don't mess with lotto tickets. They move with the meat of the move. When a fund buys calls or puts, they go for something that reacts properly. That's why they survive longer in drawdowns. Let's add a little humor. Buying low delta options is like showing up to a heavyweight fight with a pool noodle. You might look confident, but when Theta starts swinging, you're out in the first round. Now, family, watch how delta interacts with Theta. Theta's that sneaky villain in the background, counting down the seconds till your contract decays. The lower your delta, the faster Theta wins. The higher your delta, the more time you can survive. You could literally watch this play out. Go look at your broker, pull up an option chain, and look at the difference between a 0.30 and a 0.70 delta. Watch how one moves fast with the stock and the other barely flinches. All right, family. This is where experience starts separating the traders from the guessers. Guessers chase cheap contracts. Traders build positions with time, patience, and delta on their side. You can't control the market, but you control your entry, your time, and your delta. Now let's talk recovery. High delta contracts recover faster because they're built stronger. When the stock dips and then bounces, your delta actually picks up momentum. It's like a coiled spring. Low delta contracts, they don't bounce, they break. Now, family, let me say this slow. Delta measures change. High delta contracts feel the market. Low delta contracts watch the market. You don't want to be a spectator, you want to be a participant. All right, family, hit that like and subscribe button again if this is starting to make sense, because this is how you level up your understanding. You're not chasing charts anymore. You're reading the language of movement. And speaking of movement, let's talk emotions. Low delta contracts will stress you out because they move wild. 50% down in an hour, then maybe 20% up, then flat again. High delta contracts move smooth. You'll see less panic, more control. Now, family, that's why I always say, stop trying to make a dollar out of a dime. Respect the process. If your delta's weak, your odds are weak. You can't beat math. The difference between guessing and growing is knowledge. And now you understand delta like few traders ever will. Join the MBU Discord so you can connect, learn, and grow with us every morning before the bell.